Good morning, good afternoon, good evening, wherever you're watching me from. My name is Dunzo Onwordi of Dunzo Onwordi Accountancy Tutorial. Today I'll be taking you through a journey in corporate finance. This is an aspect of business that is crucial to the survival growth of an organization. Corporate finance is simply the aspect where the manager looks after the company's finances, investments, and liquidity. So basically, it's like we can look at it from three angles, three pillars of finance: financing, investments, and liquidity. I'll try and pull my slide on the screen. I hope you can see it, but I will try to make it as practical as possible, because here I deal with all my lectures, tutorial with practical examples. Okay, here is a slide. I hope you can see it. Introduction to corporate finance. What I'll be covering today basically is corporate finance and the financial manager, the goal of financial management, the financial markets, and the corporation. Let's look at these three areas. They will suffice for this particular level of corporate finance. As I said, three pillars of corporate finance will include investments, financing, liquidity. I normally love to start from financing because we need to work before we can run. Financing is where you get the resources you need to operate. You cannot operate without cash. Cash is king, supreme. So after dealing with corporate financing, I'm going to look at investments. Then we'll talk about what we mean by liquidity. Financing is basically going to the market. If I may push the slide to where we can look at that. It's basically going to the financial market and seeking for funds. This could be long-term fund or short-term fund. And it could also take the shape of debt or equity. An example of debt is loan from your bank. And an example of equity is share you issued to those interested in partaking in your business. I didn't want to go to make it short because there could be another angle of share here. You could raise funds if you are listed in the market, okay, from the general public. But if you're not listed, if you're a private company, then it means share issued to friends, interested individuals who are not in the public domain. You can either, it's like private kind of thing, as the name suggests, private company. So that is to do with share. It could be private or public. When it's public company, you can issue your share. The share can be traded in the public, in stock exchanges like London Stock Exchange, Nasdaq, or New York Stock Exchange. But if it's private, it means it has to be a private individual who you call upon to partake in your business. Now, the short-term part of funding could be from short-term loans that fall due within 1 year. And your suppliers could be another source of short-term fund, which we call payable now, used to be credit on in the past. And these are cheap, interest-free loan from your suppliers. So you go to the market and raise funds because you want to start a business, and this is the form, this is the sources you can you can go to get your finances. So having dealt with financing, let's now go back to my investment, which is now where I have to invest all these finances I've raised. Now looking at the screen, if you can see it properly, investments. Investment could take the form of inventory, machinery, lands, and labor. We all know or familiar with what we call inventory. That is your core business, the items, the products you deal with, you sell to make some revenue. That's inventory. For example, if you sell if you're a merchandiser, you have stock like crisps, sweet, chocolates, newspaper, and other items. As a merchandiser, you don't produce, that people can come in and pick over the counter in exchange for your cash. If you're a manufacturing company, inventory could be in terms of raw material, work in progress, and finished goods. Have an idea what we mean by inventory now. Machinery are the machines used in operation. It could be computer, it could be tractors. You need to move things about in your factory. Any machine you use. If you're in bakery business, you have the bakery machine, oven, they are machinery. And you have in order to produce your products. The next item under investment, that is where you invest all these funds you have raised to help you operate. The next one of them is land. Not necessarily land we stand upon, but environments, facilities that enable us to operate comfortably and efficiently. Now it could be your office, it could be the factory where you bake the bread or produce your goods. It could be a kind of a shelter where you keep things. Storage, they are all lands. That would mean by land. The fourth one I have here is labor, which is necessary. As whatever you do, you need people to work for you. Okay. Leverage, that is, you have to use people to work for the business in order to produce or run your businesses. So those labor means those kind of people, skill professionals that you need to pay for their services for your company to continue in operation. So these are what we call investments. All right. So let's move on to my next screen, a slide here. My next slide is saying cash raised must be matched by an equal amount of investment in assets, be it deposits. So let's rewind. When I said finances or financing, I will kind of demonstrate it here to make it understandable to all of us. This side I will call liabilities. And here, this side I will call assets. The reason will be clear shortly. When we are raising finance, I will look at it from the liability side of things. As I said, if you start in business, the first thing you need to do is to probably bring in your savings before you start calling people or seeking other finances. Your savings is what we call equity. I will give a heading here, equity. Your saving is equity, that's your ownership. If you are an individual, it could be called capital. If you are a limited incorporated or business, it could be called shares. So let's leave it as they are all equity. Let's say EQ still equity. Steven said. So if you start and bring in, say, from your savings, you have starting small business, you have 5,000. Let's say 5,000. You bring in from your savings. So let's say from savings. Oh, sorry. Savings. Call it 5,000. That's savings from your business, from your 5,000 from your saving account to start to take off. And as I always remind my students, whenever you have a figure written down, always ask for the opposite side of that particular figure. Savings is a credit, excuse me, in your capital account, and that's a credit. You credit your capital account for giving you the business this amount of money. You need to debit something to balance this equation. So savings will now go to your bank account, which will come under asset. Under asset, we will have what we call non-current assets, which is assets that are of a long-term nature, that are based to allow the business to continue to operate, exist. Then we have the non-current assets. Those are the assets that are within the short term, within the year, like are not necessarily going to be there for a longer time, like your inventory you sell. You don't expect it to be there for years. You want to sell them within the year. People owing you, like your debtors, which you call receivables, you don't expect them to owe you for over 1 year. So all those assets within 1 year are called current assets. So bank accounts is there to help you operate regularly day to day, so it will come under current asset. So you credit your savings, you need to debit your bank account. Let's put bank account here. Bank. So my bank account will be debited with 5,000. So my first transaction here is 1 and the 1. So this to denote how the account is being balanced. So remember we said that every finance raised must be matched by investment in assets, be it deposit. So this kind of deposit, bank account, is not yet used. So you raise 5,000 from your savings, you put it in your bank account. So both sides balance. Moving on to the other side of things. So as I said, you now go to seek more finance. You go to the bank, and the bank manager, looking at the records, your plan, agree to maybe give you 15,000 loan. So you now say non-current liability, which are the liability which are for long term over 1 year. Your bank manager now give you a loan which is over 1 year. Call it loan again of 15,000. This is another credit, my second transaction. I'm crediting the loan account for providing the 15,000 which I will need to operate with. I need to debit whichever asset I'm going to put that money into, be it deposit. In the meantime, I need to go to my bank account again because I have not actually applied that money into anything. I'm just raising funds. So that comes again to my bank account. Okay, bank account. No. Now comes again to my bank account, 15,000. Second transaction, so I can identify my transactions. So this is 15,000 debited to my bank account. The total asset now is 20,000, and total liability is 20,000. So my asset will equal to my liability. So the slide here you see telling you that in corporate finance, every finance raised must be matched by equal investments in assets, and add be it deposit. Because all this money are raised could straight away go into machinery, land, equipment, but in the meantime it's still in my cash bank account because I have not applied them. Right. So this is it. Liability equals asset. So let's move on. The question here again is, why are you starting a firm? All these things we're doing, why? What's the aim? What's the objective? What's the reason for going through all this? As you can see from the slide, the reason for doing this is basically to add value creation. The reason for starting your firm is for value creation. Nobody does anything for nothing. If you are not doing this to create value or add value to yourself, to grow, you might as well don't do this. Get unemployment and receiving salary. So the aim of starting a firm is value creation. As it is now, I have not created any value. We just raised 20,000. They are still in bank account 20,000. No value has been created yet. Assuming there is no interest accruing to this. Let's assume no interest. Now, to create value, you need to work on your assets, investments, financing, liquidity, everything you have here. You have to manage them properly, turn them around, invest in assets that cost less than you buy them. invest in assets that you can sell for more than they cost you. So like this 20,000 a year, I can invest in assets, buy assets now properly, not cash, like inventory, that if I sell them, I will get a bigger return than I buy them in the first instance. You get me? So basically it's saying the duty of a financial manager, excuse me, you look at the screen, the responsibility of corporate finance manager are to buy assets that earn more cash than they cost in the first instance. These are one of the responsibilities of financial manager. So now, let's see how we do that. I am going to invest in inventory, say for 5,000 inventory, with the hope of selling them for more than 5,000. And if you have enjoyed this particular lecture, tutorial, kind of, give us a thumbs up. Please subscribe, because it is by subscribing you encourage us to put in this time and effort to produce materials in a way that are practical for you to follow and understand. So until I see you next time, take care of yourself and goodbye.